Okay, hi there, it's Jeff here again with another in our series of industry or market profiles. What we do here is we take a sector, in this case, the food delivery market, and just think about some of the economics of it, a bit of application, thinking about how it relates to exams, so on and so forth. Really quite interesting because you've got the theory. I'm sure you've got fantastic theory now ahead of the exams, but I think application is really important as well. In the live stream a few days ago, I was doing a session on contestable markets, and I did say that I think the food delivery market is a really interesting example of that in action. Essentially, it's an oligopoly, although it depends on how we define the market, but a lot of smaller firms trying to nudge in and get a piece of the action. So the food delivery market has clearly expanded extremely quickly in recent times. Obviously, that was a catalyst for that was the lockdowns. Was it 2 lockdowns we had, didn't we, during the pandemic? Lots of restaurants were closed, and clearly household demand for food delivered from restaurants in particular surged, as well as, of course, online deliveries from supermarkets and other retailers. The food delivery market, if we think about from restaurants through the third-party app to the consumer, that is a contestable market. But it's also dominated by, 3 firms, Just Eat, Ubereats and Deliveroo, the UK business. But we also have a growing number of smaller firms offering grocery services, food deliveries. They've entered the market, many based in cities. The thing about cities is that the marginal cost of providing that final mile service is probably, it is lower than in outlying rural small towns, for example. There's a bigger scale of operation and potentially therefore more profitable. And I will say a few things about Get Here, which I think is one of the most interesting and prominent of the new rivals on the block. So food and restaurant delivery services, basically they're platforms. So the likes of Just Eat, Delivery, they're platform businesses that enable people to order a cooked meal from a restaurant or via a website or usually from an app and have them delivered to home. According to a Statista survey in the early months of 2022, these were the online providers of these services that people had used in the last 12 months. Something like 2/3, nudging towards 3/4 of people had used Just Eat. Deliveroo was popular, so too Uber Eats, and of course obviously Domino's. We've all probably ordered from Domino's, Pizza Hut, Nando's. Oh yes, Papa John's, Food Hub, and others. So you have a size. I mean, we're talking millions of people ordering each year. I think I was reading Deliveroo's interim report just a few minutes ago. They've had something like 8 million active users of the app in the last 3 months. In other words, the 3 months from sort of February through to May. I mean, millions of people using these apps, and the market is getting bigger. So the size of the pie, if you'll pardon the pun, is getting bigger. The food service delivery market in the UK was valued at 11 billion in 2020. That was much higher than the year before. Forecast to grow to 12.6 billion by 2024. You can work out the percentage change there. And one of the key metrics in the industry is how much people order per user, per person per year. The average revenue per user per year is forecast to rise to £150, £3 a week by 2023. Which leading consumer protection business discovered 7 out of 10 people use these apps. The average 30-year-old UK resident spends £8.50 a week on takeaways. Now, do you spend more or less than that? So this is a market which is genuinely contestable. And of course, it depends on how you define the market. So Deliveroo, Just Eat and Uber Eats dominate the kind of restaurant to consumer market. They're branching out as well. HelloFresh, actually co-founded by a former student of mine. HelloFresh is a popular business that delivers ingredients and menu options to households. Get Here is this new Turkish entrant. I'll talk about that in a second. And of course, they've got long-established businesses. They've been doing this for donkey's years, including Domino's. Just a little application here. These are the kind of the number of delivery apps in the UK by downloads. Uber Eats, wow, just under 6 million. Deliveroo, huge numbers. And then we go down. And that includes things like Tesco, grocery and club card. Tesco, of course, was one of the first supermarkets to enter the market for home delivery. Get Here is doing remarkably well. Look at that, 2 million app downloads for what is effectively a startup in the UK. Gorillas is a German ultra-fast delivery company, Sainsbury's, Pizza Hut and so on. You get a feel, don't you, for just the scale of the number of app downloads. So just a quick thought or words on some of the big players. This is an oligopoly. The market is dominated by Deliveroo, Just Eat and Uber Eats. Deliveroo last year, 150,000 partner businesses, 180,000 delivery riders, 26% UK market share. Of course, the key thing is the price, the charge they make to the restaurants. So typically, the commission charges vary between 20 and 30%, and that's when they're charging the restaurants. Just Eat is the biggest player in the UK. You can almost use it as an example of a dominant firm. They have 45% of the market in 2021. They are the leading food delivery business. And for restaurants, they charge a one-off joining fee of £295. I think, by the way, Deliveroo used to charge about 450 quid for restaurants joining, but they waived that, I think, during the pandemic, so I'm not sure what it is now. Just Eat has a lower commission fee. They also charge the admin fee of 50p per order. Uber Eats, 27% of the market. So add those three together, 26, 45, that's what, 71, plus 27, 80, 98% of the market is held in the, is that right? Yeah, 53 plus 45, 98% of the food delivery app. If you define it in that way, the third-party apps is in the hands of 3 players. But it is a contestable market if you broaden the definition to food and grocery deliveries. Uber Eats, one-time activation fee for restaurants, a fee based on the percentage of each restaurant order placed using the app, typically around 30%. Interesting. So Just Eat has the lower commission fees for restaurants. We'll come back to some other aspects in a second. If you get a question on oligopoly, which this is really, then it's very important to talk about interdependent decision-making between firms and the shifting balance between price and non-price competition. This was a survey in 2021 asking people, what are the main factors that you think about when choosing your food delivery app, if you're using one? Delivery fee came top, delivery time came second, availability and frequency of discount codes third, the ease of using the app low down. Presumably most apps are fairly easy to use. But if you make that distinction between price and non-price competition, it could be easily an exam question. Obviously, competition between providers in terms of delivery fee per transaction. Do they charge an admin fee? And what kind of discount codes and special offers do they make available? Non-price competition, things like ease of using the app, delivery times, reliability of those times. The quality of customer service, really important, including refunds for failed delivery. I've had that on several occasions. And also the range of restaurants available on the app. What kind of choice have you got? I think it's a good example of an industry, isn't it, where price and non-price competition is tremendously important in driving the market share and sales. What I've just done here, this may be a little out of date. Apologies for this, but I'm just trying to get a feel for the standard service and delivery fees in the market. So Deliveroo, standard fee is 5% of the basket. Delivery fee is variable based on location. They also charge a service fee, which goes towards improving the app, apparently. Uber Eats, 10% of basket, 1.29 million, £2.99 max. Again, delivery fee based on the distance. Just Eat service charge 5%. You see here that the kind of service charge are fairly similar. And you'd kind of expect that, wouldn't you, in an oligopoly because of independent behaviour. So these companies can often get locked into a relatively low service charge for consumers. Deliveroo, of course, is trying to move into this kind of subscription model. So you pay £3.49 a month to get 3 deliveries. So the Amazon Prime approach is obviously worked tremendously well for Amazon. And although some brands across all 3 platforms, others are less so. So KFC can get it from any platform. But obviously they're looking to build the range of brands as a form of non-price competition. Just a quick word on Deliveroo. Interesting business, fascinating business. I mean, it's huge. We work with 160,000 restaurants and grocery partner sites. Wow, 180,000 riders. It's a major, major employer, is Deliveroo, across 11 countries. They had a stock market flotation in a couple of years back, I think. Raised quite a bit of money. The share price hasn't done very well since. But of course, the key thing here for the exam point of view is that Deliveroo is a public limited company. So it must respond to and be sensitive to the demands and needs of shareholders, many of whom have deep pockets, because Deliveroo has never made a profit. In fact, the loss before tax last year was £298 million, which is well up on 2020. They make a gross profit on what they do, but when you factor in all the other costs, including things like marketing spend and technology investment, they make a big loss of about £5 million a week. Some people argue, this is not good news for investors, by the way, some people argue that Deliveroo will never make a profit. So why would you invest in a company that's highly unlikely to make a profit? Well, it will do if it survives and becomes the dominant player, potentially. Interestingly, Deliveroo has now launched on-demand deliveries from a range of other retailers, WH Smith's, Boots, for example. So they're having to diversify, trying to get economies of scope. Good example there. They're delivering from thousands of supermarkets, including partnerships with Waitrose, Sainsbury's and Aldi. And in the labour market, Deliveroo has faced a lot of criticism over low pay and not really focusing on workers' rights. They've recently signed an agreement with the trade union, the GMB, the General Municipal Boilermakers Union, I think, GMB. So they're going to pay minimum wage for their riders, but only while delivering an order. If you're sat in Mackie D's waiting for an order, you don't get paid. Interesting. So people who ride for Deliveroo are self-employed. They're not employees. So why do food deliveries lose money? Well, this is an interesting market. It's a contestable market where the profits actually are not that high yet. In fact, as far as I can see, none of the major food delivery companies in the UK make a significant operating profit, despite the fact that demand and revenues have gone up. Lots of reasons. First of all, they're having to spend heavily on marketing. And this, again, is one of the features of oligopoly, isn't it? The companies spend huge amounts, sponsoring Euro 2020 and sponsoring BT Sport, all that kind of stuff. Big spend on marketing is a fixed cost, which, you have to pay even if you don't sell any food or deliver any food. There is pressure to lower delivery fees for consumers, and I think that's a good area where you might bring a bit of game theory in. And if you don't charge a low delivery fee and others do, then you're going to lose market share if consumers are price sensitive. Typically, though, in this industry, there are problems in generating incremental revenue. So if you think about airlines, for example, they charge a low price for their ticket, but then they make lots of ancillary revenues from things like on-board duty-free and food and drink and what have you. The delivery companies don't really make a lot of incremental revenue at the moment. They just charge for delivery. That's it. Service over. Obviously, as they grow, they've got increasing labour costs as they take on more riders. You might think about how you could draw a cost and revenue curve diagram for that. They're certainly under pressure to increase wages, particularly given the labour shortages in the UK economy. And also they're under pressure to recognise employees as employees and pay things like sick pay. And they've got the huge fixed cost of the platform infrastructure. So you can make a case for saying that there's a natural monopoly element here. Building that infrastructure, the bandwidth and all the infrastructure that goes behind these platform businesses is a huge fixed cost. And these are reasons why it's hard to make money at the moment. Just want to say a few things, if it's okay with you, about Get Here. I think this is a really, really interesting example if you're revising contestable markets. So Get Here is what's known as an ultra-fast grocery delivery company, UFGD. Founded in Turkey, Turkish entrepreneurs, and they operate widespread across Turkey, but now are operating in nearly 50 cities across Europe and the United States. So it's been around for 7 years. They've pioneered the sector with its 10-minute delivery model. Wow. Delivery of £1.99 charged on orders below £20. They charge more in London. They have a vertically integrated distribution network. So the key to this business is from food manufacturer, whatever it is, manufacturer of shampoo, for example, those products, they don't make them themselves, but they then arrive in warehouses. From warehouse, they get picked straight to delivery riders. The app, of course, is the interface between the consumer and the warehouse. and the final mile service to the consumer. So it's vertically integrated. Now, crucially with Get Here, the platform works with local warehouse operators on a franchise model. Okay, so the warehouses, sometimes known as dark stores, they are in charge of stocking and fulfilling products, and really quickly. Again, it's based around cities: Manchester, Liverpool, Portsmouth, actually, Birmingham. So cities tend to be more profitable. Interestingly, Get Here is a registered living wage employer. So their riders are paid the living wage. All employers receive pension, sick pay, paid holidays and insurance. That is in contrast to Deliveroo. And they're sustainable in the sense that they are one of the biggest buyers now of electric mopeds and electric bikes in the UK, actually, which brings down the price for them, but it's also more sustainable. How does it make money? By the way, the picture here is, I think, one of their dark warehouses in Battersea, I think, in South East London. Well, the revenue comes from selling stuff at a markup. They charge a high price, okay, because people are willing to pay a high price for very quick delivery. So typically it's more expensive than usual supermarkets. The warehouse partners are franchisees. So Get Here doesn't own the warehouses. The warehouses are owned by warehouse entrepreneurs who are franchisees, which means that Get Here doesn't have to pay any rent. Let the warehouse pay the rent. That avoids the need to employ retail employees because their warehouses do that. They only stock a limited range of groceries. Okay, a little bit similar to Aldi and Lidl. They reduce the range of products. Therefore, they sell more of each product, and that gives them more purchasing power with the suppliers, which lowers the buying price and the economy of scale. And the markup is, obviously they charge delivery and other fees, but the markup is the main way they make profit because people are willing to pay for that. Really interesting. Get Here as your example of a challenger brand in the market. So the market is changing. This market is highly contestable because I think consumers are pretty much price sensitive when it comes to delivery fees, and the barriers to entry are low. The entry of Get Here and other firms is a good example of that. Consumers, in a sense, have market power because they can request lower prices and higher quality. It's pretty easy to switch app, isn't it? Switching costs are low, so you'd expect the cross-price elasticity to be pretty high. And the price competition between these firms, Ubereats, Deliveroo, etc., is leading to profit margin erosion, so that makes it harder for them to make a profit. In contrast, though, the bargaining power of workers is low because these are big employers. So how, if ever, could these businesses make money? I think Get Here will be profitable because they've got a different business model. Use that as an example of process innovation, by the way. But what's the path to long-run profit? Well, probably merger and takeover. So there will be some consolidation in this sector. Big players will merge. Big players will take over smaller firms because to be profitable, you need to have huge economies of scale. Now, Just Eat took over Grubhub a couple of years back. It's already widely seen as a failure. It hasn't not been a success. I think there'll be more joint ventures between delivery firms and other retailers. So a good example of that is Deliveroo partnering now with Boots. So delivery companies will be delivering medicines and whatever it is. Okay, that's to get the economies of scope, and investment in dark kitchens. So I think Deliveroo is doing this. They're building dark kitchens where the likes of Nando's and Wagamama, they'll make the food in those dark kitchens, which can go directly from there within cities to the final consumer. They won't go via the restaurant. They'll go from the dark kitchens where you can concentrate a hub of food production and then deliver quickly at low cost. That's probably the pathway to profitability. Thank you for joining me on this, but I really appreciate it, and I don't take it for granted. If you stayed all the way through, hopefully it's been useful for you, and you give it a thumbs up. Just wanted to finish with some topical exam questions or some topical related things on the industry. So this is a great example, the extent to which competition between firms leads to good outcomes for consumer and social welfare. To what extent is the rise of food delivery beneficial for households? Or are they paying more than they would normally? Is it good for social welfare to have this whole army of delivery drivers and riders all over the place? Think about the impact of changing costs and revenues on profits. You may well be able to use a cost and revenue diagram to show why firms make a loss and how they might be able to make a profit. Linked with that is the economics of the shutdown point. At what point does a firm shut down in the short run or the long run? Think about that. Challenges of rapid growth of demand. So to what extent might these businesses be growing too quickly, leading to diseconomies of scale? And what are the difficulties in attracting employees in a tough, tight labour market? What are the factors affecting labour supply in this industry? What makes people want to work for Deliveroo rather than other companies or other jobs? Think about the impact of government intervention, taxation, for example, on online deliveries perhaps, or changes in the minimum wage. It's a good example of thinking of the benefits and drawbacks of mergers and takeovers. And I think overall it's a good example of an industry where there is increasing contestability. Get here would be my example there. And the nature of entry and exit barriers. Why have the entry barriers come down? Or, are there still some entry barriers in the market, particularly when you get delivery companies that reach that scale and breadth of operation, which makes it pretty hard to compete against. Well, there we go. This was hopefully a relatively accessible look at the food delivery market. It's an interesting one. I think it's one where there's lots of economics, and hopefully that was a useful session for you. Stay positive, stay hopeful, stay happy, and hopefully see you sometime soon.